Welcome back to the channel. Today I have another guest with me today, David Nicholas from Nicholas Wealth Management and the fund manager of X Funds. Welcome back to the channel, David.
Brad, great to be here. Excited. Love the channel. So grateful to talk with you today.
Let's go ahead and talk about two elephants in the room, GIAX and BLOX. What's going on with those two funds?
Yeah, absolutely. I thought you were about to say the elephant in the room, my beard, because you called me out earlier, Brad, saying portfolio managers don't have beard. So I just gotta get you to grow the beard out, and then we'll be even here. But yeah, so lots of changes, exciting changes. We can start with GIX. GIX was really a fund, Brad, that you really talked about first before really anybody else, and so. One, it's a fund that was very unique when we launched at the time. Obviously, it has a broad global exposure, international, large cap, small cap, mid cap, really an all cap global exposure. And we also did something unique that actually there wasn't any other fund doing this as well in how we structured our options overlay, because it was really unique in that the options overlays that we were writing on the fund didn't necessarily match the underlying positions. And so, again, very unique structure. And the whole idea behind that was, well, possibly if we could get the underlying positions to outperform the indices that we were riding our spreads on, we really would have this really unique strategy where we're getting upside and also not getting any drag from the options that we're selling. We ran that strategy and it worked fine and kept up reasonably with the S&P. But when we launched BLOX, we came up with a structure that we back tested and really saw a unique structure where you have half the portfolio of calls selling call spreads, the other half of the portfolio is selling put spreads. And they really do, in our opinion, a better job of balancing both growth and income as well. And so we figured, why wouldn't we run the same thing in GIX? It's doing well in BLOX. We like being on both sides of the trade, the put side and the call side. So we rolled that out with GIX. So we're now writing call spreads, still call spreads, but we're matching the underlying positions of the ETF. So roughly 40 to 50% of the fund are ETFs. These are emerging markets, international, small cap, mid cap, large cap, S&P. We write call spreads on those positions, but then our individual equity positions. And these are, you've got your large cap names, you've got some names that we are bullish on. You can see them here on the screen, like Robinhood, Nebius, Google, Taiwan Semi. We're writing put spreads on all of the underlying positions. So again, what that means, I know you know this, Brad, I know a lot of your viewers know this as well, but when we're selling a put spread, when those positions go higher, we are completely uncapped. So we're getting all the upside of those put positions. The negative to selling puts is that when those positions go down, we're going to be down a little bit more because of the spreads that we're selling. But if you really want growth and you want income, selling puts is a really good way to get both upside growth and also generate income as well. So excited about the new changes, Brad.
Can you go through your top holdings that you have there? Let's go through the top 6 holdings and what they actually are.
You'll see really right away, we've got the FTSE, the VEA, which is the Vanguard Developed International Market. So think of developed is the opposite of emerging, right? So developed are going to be your large nations across Europe, across Asia. So these are generally nations that are, I would say, lower risk in that they're developed, and it's really a way to get global exposure. And we also balance that with our Freedom 100, which I'll jump down to that in a second. But so right away, we're going to get our international exposure. About 10% of the fund is developed international markets. And so again, what I like about that is we've seen US large caps perform well. We've also seen international have a very good year this year, but there's been so much concentration in just large cap US. And so if you think about your portfolio, yeah, you may have done well in the last year or so, but as we look forward, we say, well, everything comes back to the mean at some point. And so we like having a little bit of exposure. We generally feel 15 to 20% internationals, when you look at a total balanced portfolio, is what we want as exposure to international. So that rounds out our first position. We all know VOO, VOO, SPY, 7% allocation to SPY in the fund. We've got the mid-cap ETF, which is Vanguard's VOT. I think mid-caps are at almost the sweet spot right now. You've got an accommodative Fed, hopefully, going into 2026. We have the markets pricing in 2 to 3 more rate cuts as we get into next year. All of that bodes well for mid caps. And I also like the reason we're overweighting mid caps slightly. They're in line with small caps. But again, a little bit higher up on the risk scale than small caps. They don't have as much exposure to debt. So they have usually stronger balance sheets, less debt, but really higher, in my opinion, upside potential over large caps over the next 12 to 24 months. Freedom, I love this fund. We're actually, GIX is actually one of the largest shareholders of Freedom ETF as a position size. What I love about it is it's all emerging market stocks, ex state-owned enterprise companies. So again, that eliminates a lot of China, that eliminates parts of South America. It eliminates, I would say, anything that has heavy state ownership or communist ownership, it removes from the fund. So that was important to me. I think it's important to a lot of our shareholders as well, which is why I love Freedom. We all know small caps that I just mentioned. Maybe I'll just talk about some of the equities really quick. So really, when you look at the top three equity positions in the fund, NBIS, Nebius, which is going to be the AI data center play. You've got Robinhood, which we know Robinhood as well, and you got Tesla. Names like NBIS, names like IREN, these are high growth. I wouldn't necessarily call them high risk, but they are high growth. And I always say the hardest time to own companies like Nebius and IREN is the phase that they're in right now. And the reason for that is one, because you have heavy CapEx spending, right? These companies have to build out these data centers. Sometimes you get dilution because they're having to sell shares with a convertible notes or issue shares to be able to meet demands for contracts, etc. So this is it can be a choppy time to own the stock. But if you're willing to go through some of that choppiness, you generally are not going to miss the big up move. And they can happen pretty quick. Right, names like these can move 20, 30, 40% in just a matter of weeks. So this is why we like a name like this. We also like the standard deviation of a name like NBIS, really good put selling potential. So we generate a lot of income off of it, which is great. Robinhood, don't have to spend a lot of time on that, but we know really, I would say the custodian of the future. More millennials use Robinhood than any other custodian. So we really like the upside potential for Robinhood, obviously exposure to the crypto space. Tesla is back up in our weighting. We had a lower rating before the rebalance. This is not a bet, Brad, on Tesla's automaking ability. If you believe in AI, you believe in robotics, and if you believe in self-driving, you want to own Tesla. I know the valuation is absolutely insane. If you're a value investor, you're not loving the valuation, but it's not that valuations don't matter, but you're making a bet on the future. We know Palantir, similar story with valuation, but we've got this group that is, I would say, high vol but high payoff, and then we balance that with our Mag 7 names, strong balance sheet names like Meta, Google, Apple, Microsoft, Taiwan Semi, Amazon. The amazing thing right now is a lot of these Mag 7 names are trading tip under what their 5-year forward PE rate valuations typically are. So I actually think this is a great time to own these names. It's a great time to have the balance sheet strength. A lot of these names are spending on AI, but they've got the balance sheet, they've got the cash flow, and they've got the EBITDA to keep that spend going. So we think it's a good mix of large cap, but then you also get your international, small cap, mid cap, and some of your higher vol names inside the portfolio, Brad.
Give me your personal opinion between OpenAI and Google. And what does your 8-year-old think about it?
Yeah, that's funny. I mentioned that on Fox the other day. So, you may think it's crazy that an 8-year-old knows about AI. It's pretty actually shocking how my daughter, Bella, who's 8, she knows, I'm not going to say she knows more than about AI than me, but she knows so much about AI. Her and her friends are that's a real beard, Brad. That is not an AI beard. I'm pretty sure. The interesting thing about it is she and her little friends like to create fairy pictures and videos and stories all on these different programs. We monitor it and make sure we're monitoring what they're doing. But it's interesting because she even made a comment to me the other day, and I said, Bella, baby, what's your favorite one of these programs? She's like, by far, Gemini. Gemini's way faster, and the pictures are a lot better. And it was really interesting because it actually just confirmed my research on Google. We slept on Google for a while, or many investors slept on Google because the idea was that AI was going to replace search, but Google is completely primed, right? They have 2 billion eyes on it every day through search. OpenAI is going to do just fine, but Google is 70 to 80 billion dollars in free cash flow every single year. That money has to go somewhere. I would rather that money go into AI capex, Brad, than just sit in treasuries earning 4%. So to me, yeah, they're spending a lot, but I actually think Google will win out because when you integrate search, when you integrate chat box, when you integrate just like Gemini and the video and editing programs, Google has a really good stack that I think will end up winning this AI race.
I'm going to have to question your Opendoor technologies down there at the very last one. Tell me about Opendoor and your thoughts on Opendoor.
So we could make an argument that we may be a little early on a name like Opendoor. Throughout my career, I've always said that being early hurts in the short term, but it really pays off long term. So the thesis on Opendoor really is a macro argument on what do we think about the housing market going into 2026. The housing market is antiquated. The process for buying a house is antiquated. Apologize to all of our, and I have friends and family members that are realtors and really good realtors, but the process is really one that's challenging for buyers. I actually think Opendoor is going to make a lot of changes to how we buy homes going into 2026 and forward. And so when you think about the setup of a Federal Reserve that is accommodative, you have a new Fed chair, you have more than likely interest rates coming down. And oh, by the way, you have a company like Opendoor who's making it easier to buy a home for millennials who are trying to get access to homes. I think a name like that does very well. And so we're probably not going to see the real move for that stock, I think, will be next year. But hey, we'll sell premium against it now. We'll own it. And it's our smallest weighting in the portfolio, 2%. If the stock goes the other way, we don't want it to, but it's not going to hurt the fund significantly. But if it doubles from here, which I think it very well could, it'll be a nice additive to the fund, Brad.
David, how has the distributions been since both of these funds been out with these high distribution rates? Is this fake money or are you really making these distributions?
Yeah, it's a good question. So I always say not all income is equal, right? And so you can generate income a lot of different ways in a fund. You could generate income by just using leverage and then selling shares and distributing that to shareholders. You can sell use covered calls or call spreads or put spreads. So we are using actual income that we generate from our options positions to meet our distributions. And especially when you're dealing with put spreads in a bull market, the majority of that is going to be coming from the put spreads. In a bear market, right? If you're selling put positions, equity markets are going down. Could you be in a position where if you're trying to meet a distribution, you either have to use cash or trim some positions to make a distribution? It's possible, but the majority of the time in an upward moving, sideways to upwards moving market, that income is going to be coming from the options positions that we're selling, Brad.
When you're managing your distributions, do you have a small bank, meaning, hey, last week's calls are only meeting next week's distributions? Or do you actually have maybe a week or a week and a half worth of distributions already saved?
Yeah, so one of the worst things in a fund is drag in a fund, meaning you don't want to hold too much cash. Cash can be a good thing, especially if markets are going down. But no, I mean, we generally are going to have these are weekly distribution funds. So we are usually going to be a week ahead with enough cash available to meet next week's distribution. So we keep it pretty tight, but our options positions are typically every 2 weeks that we do expirations, mainly because, we just get a little bit better premium. The math works out better to write our options in 2 weeks versus 1 week. So again, that rolling 2-week period, it's going to be coming due. So we've got enough cash for that interim week where we're making distributions before the next week income comes in. Keep it pretty tight. But again, on a 36% yield distribution fund, 3% a month, it's a little less than 1% per week. For GIX, it's about 0.5% that we need per week. So it's really not a lot of cash that we have to keep to be able to meet those distributions.
On GIAX, how much of that 24% are actually coming from the single stocks, since you're writing puts on those or put spreads, versus the actual index or the larger funds that you have with your call spreads? Are they generating significantly more income than the call spreads?
They have potential to generate significantly more income. We could almost generate all of the income that we need just from the equity positions if we wanted to, if we went right at the money, just because there's much more vol on those positions compared to the indices, which have a lot lower vol. So to answer your question, yes, a lot of the income is coming from the individual equity positions. But when we sell call spreads on the indices, that allows us to be a little bit more conservative in our put selling. So we don't have to go right at the money, meaning we can actually give ourselves a little bit of a cushion to where if the stock goes down, we may sell our short puts, 3 to 4% out of the money, or 3% under our strike, the underlying price. So it just gives us a little bit of a buffer where if we went right at the money for every single position on that side, we'd be able to generate even more than what we're distributing. But we run these positions a little bit more conservatively.
There's a lot of concern within at least my community about the connection between X funds and Tidal, meaning Tidal is a very big organization, and are they giving David Nicholas the sources to actually be able to do this, or do you really influence where the put spreads and call spreads are actually placed?
Yeah, so Tidal has been a great partner, and Tidal has, gosh, I think over 100 and I forget the number, but it's up there, over 100, 150 different funds, many different managers, many great managers that you've interviewed, Brad. So I would say though that each fund company operates very differently. And even though Tidal may be the back end kind of engine for compliance, regulatory filings, and even trading, if you want them to be, I would say we couldn't be more different in how our funds are structured, right? And so, yeah, I would say all of the decisions that we make inside of X funds are driven from the X fund side. The options trading team is with Tidal. And so from a day-to-day basis, right, as we're rolling trades, as we're distributing income for distributions, that's manually done by Tidal's trading team. But it's not that Tidal's trading team is making decisions that are independent of what, the instructions that we've given as a portfolio manager. So I would say that the traders are really there to implement my strategy as a portfolio manager, to really just do the nitty gritty of the buy and sell of these options positions, but not the overall strategy of where and how these positions should be driven. So you've got some funds where they distribute max income out to shareholders, and then you've got funds like ours that we hold back some of the income because we want capital appreciation. So that directive is driven from my side as a portfolio manager, not necessarily from Tidal's side as the traders or the back office. But Tidal can play different roles for different funds. But for ours, at least for the funds currently, they are in a trading capacity. But really, I tell you, and I know you know some of this, Brad, but if you knew all that goes into regulatory requirements for an ETF, Tidal really does an amazing job to help keep that side of it done, so we can actually focus on managing the fund for our shareholders.
David, let's talk about blocks and how you structured blocks and some of the actual underlyings in blocks. Tell me about the Bitcoin and Ethereum holdings.
If you look at blocks, the way it's broken down, I would say we could break it down into really maybe 3 or 4 camps. The first one is like the direct exposure to crypto through crypto ETFs, namely Bitcoin and Ethereum. So about 40% of the fund is Bitcoin, Ether. That's going to be somewhere between 40 to 50% typically. And so we use underlying ETFs like HODL. We use FBTC to do the ETHA for our Ethereum exposure. And we're generally going to be selling call spreads on the crypto side of the portfolio, which has actually paid off as, unfortunately, Bitcoin and Ether have dropped in price. We've been able to make that premium every single couple of weeks, get 100% of that premium as those positions have been going down. So that's one of the benefits of selling call spreads when the underlying is going down. So that's about 40% of the portfolio. And then you've got really, I would say, another 20 to 25% of the fund, just really your miners, but they also may have some other exposure to data centers and AI merging as well. So that's going to be like Cypher, Riot, you've got Hut 8, you've got Iron, and then you've got the semis that also are tied. Obviously, with Bitcoin mining, you need compute, you need computing power, you need chips. So we've got TSM and NVIDIA in the portfolio, just under 10% of the portfolio. And then you've got your exchanges or your custodians, Coinbase and Robinhood. So it's really giving you a mix between the biggest exposure is direct Bitcoin and Ether. And then you marry that with some of the miners that have also crossed into some of the energy that provides for mining and also AI infrastructure as well. And then you've got the semis, and then you've got the exchange and the platforms as well. So I really think what we wanted to do with all of our funds, and especially some of the new ones that are coming out, is when you think about a sector, right, saying, hey, I want exposure to a certain sector. So if the exposure is crypto is your sector, well, how do I get exposure to it? I could just buy Bitcoin. But the point of the fund was we want to give you the broadest exposure to the crypto space and do it in a way that provides you upside growth that also can generate income along the way. So you get with BLOX exposure to direct crypto with the underlying ETFs, Bitcoin and Ether. You get exposure to the miners. You get exposure to the custodians. You get exposure to the data, the hardware providers like Taiwan Semi and NVIDIA as well. So it's kind of like the total package exposure to crypto. And then the way we're structured again, Brad, is call spreads on the Bitcoin and Ethereum funds, put spreads on our individual equity positions. So if you notice, I mean, if you just look at BLOX just compared to the performance of Bitcoin, I mean, it's still, I was just looking at this chart the other day. So since we've launched BLOX, Bitcoin is actually down 15% since over that time period. So, but if you look at BLOX is actually still up total return 15, 16% over that same time period. So there's a spread of about a 30% spread between the total performance of BLOX compared to the return of Bitcoin. Why is that? Well, again, as the underlyings have been dropping, we've been earning premium with our call spreads. And for those months of June, July, August, September, going into October, where the equity positions were going straight up like a rocket, we were also generating the put spread income from those positions as well. So we've kept all that income. And so all of that goes into the overall total return of the fund. So been really fun. It's been an amazing ride and just grateful for all the support that we've seen from investors. But I think it's why a strategy like this works on a high vol sector, generate premium along the way. And then over time, we want the NAV to rise as the underlying positions hopefully continue to go up in price.
I know that you answered this on Fox News. Why has Bitcoin price gone down?
Yeah, it's been a very strange sell-off for Bitcoin. I could give both sides of the argument. One is just the contrarian or the negative side is Bitcoin had a pretty impressive rally off the April lows. So if you go back from the tariff scare from April till now to the peak, Bitcoin was up 60%. That was twice the return of gold. Gold recovered about 30% at its peak. It beat the Qs, beat the S&P, beat small caps, beat mid caps, beat international. I mean, Bitcoin just had a massive rally. And so I think naturally you're going to get profit taking. So I think in the simplest form, there was some profit taking, but that's not the whole story. So then you also have these liquidity issues with these exchanges that led to the selling. But anytime that you have an asset that runs up really high, that's also using leverage. So if you look at a name like MicroStrategy, that's essentially using leverage to purchase Bitcoin. You've got less liquidity, you've got profit taking. You really almost have this perfect storm of, all these things happening at the same time. And then added to that, and the external factors of, there was just some concern over AI and technology as a whole. And so Bitcoin is still a risk on, risk off asset. So when you get an environment of risk off, concerns about AI and tech, you get an asset that has actually outperformed every other asset class. And then you get some liquidity jitters as well. We can talk about the yen carry trade as well, which is probably part of it also. All that hit at the same time, which is why I think you see Bitcoin selling off. But if you look at the charts, To me, 80 to 85,000 is the low for Bitcoin. I've gone on record saying that. Could we breach that? I think it's possible, sure. But I really feel 80 to 85,000 range is really good support for Bitcoin. And so I think, if you're looking to add to positions, this is a great time. But I would feel confident that we should see a retrace to all-time high in 2026.
Okay, you opened yourself up to two questions. Yen carry trade. What is it and why is it important to not only Bitcoin, but the general market as a complete marketplace?
Yeah, so if you look at the history of Japan, for 3 decades, Japan has had very low interest rates. They struggle. This is looking at like demographics and the macro situation for Japan. Low birth rates. So you have a population that leans a lot older. The demographics lean in Japan versus because they just didn't have enough babies. So that really hurt demographics. So you had a period of just low growth. And so Japan has held interest rates near zero for decades, while many other countries had much higher rates. And so this allowed for this thing called the yen carry trade, not to put us all to sleep here, but basically you could borrow in yen, okay, and then you could invest in US dollars. So you borrow at 0 to 1%, and then you invest in US at 4 to 5%. So that spread is what you call the carry trade. And so hedge funds would do this where they would borrow in yen at very low interest rates. Then they short Japanese currency or they go long the US dollar. And so it made for a very almost risk-free profit between when you're borrowing in yen and you're buying US assets. The challenge though is what happens is, well, one, we have inflation. Two, we're actually starting to see some growth in Japan. And so those two things, actually, Japan just came out recently and just said, like, we're more than likely enough to raise interest rates. And so what happens is when you look at Japanese rates that have headed higher, every incremental move in rates going higher in Japan lead to outsized liquidations on the US side. And so this is really what's been happening as rates have been going higher. We see liquidations here in the US. A lot of it's been in technology sectors, a lot of the high growth sectors. It's not like this just happened though last month. And this is where I want to say it's not like that's everything to account for what's happening with Bitcoin. This has been going on now for, if you look at the last year or two, interest rates have been steadily rising. But if the fear is rates are going to continue to head higher going into 2026, hedge funds are going to want to start to unwind that trade now before they really get hurt going into 2026. So that was really a big pressure point on Bitcoin as well as the tech sector in the last month and a half.
Question number two, and you brought this up, MicroStrategy. It's still in your funds. What's your thoughts on MicroStrategy? There's been a lot of fear, uncertainty, and doubt about MicroStrategy, especially the prefers, and they just made some recent changes, or at least have money set aside for their actual preferred stocks now. What's your opinion about MicroStrategy and what's going on with them?
Yeah, so it's interesting. We have MicroStrategy in blocks. It's actually one of our lowest allocations. I'm just looking to see what the exact allocation is of MicroStrategy. I think it's less than 1%. Here's the challenge. I actually did an interview with, I think he's a buddy of yours, Ambassador Kwan, when we just launched the right after we did one with yours, and we actually talked about MicroStrategy. This was when MicroStrategy was flying at all-time highs. And one of the things that I said then, and it's come true today, was when you look at the cap stack of MicroStrategy, every time that Saylor would issue preferreds to buy Bitcoin, he was also issuing common as well. So he'd issue common, issue preferreds. And what was interesting was retail would buy the common, institutions would buy the preferreds. And so if you understand where the cap stack is, preferreds sit above commons. And so the real interesting thing was it was almost like retail was the one ultimately holding the bag, while institutions were backed up by the assets, which are the underlying. Because again, common shareholders really have no claim on assets by the time it gets all the way down the cap stack. the preferred shareholders, the debt shareholders do. And so that to me was kind of the first warning sign that not that the structure is broken, it's just if Bitcoin drops enough to where you're seeing it today, but today it's still manageable. But if it dropped lower, continued to drop from where it is today, you really put at risk the common shareholders. And then actually you start to put at risk the preferred shareholders as well as the institutions. And so I think it's just a challenging structure. And I think the market at first was very excited about it. But then it's now when you really think about it, it's like it's a proxy for Bitcoin. It's a leverage way to play Bitcoin. So as Bitcoin price goes down in value, it's going to have leverage losses to the downside. As Bitcoin recovers, it should head back up. I just think the days of having a premium to the book value of the underlying assets of the Bitcoin, those days are behind us. So if you're not going to get a premium to the Bitcoin, what's the point of owning a name like MicroStrategy? You own it for the premium. Wish them the best, but it's also why we have a low allocation on MicroStrategy. It may be in the future that we don't own any at all, but we still have a small position in it because, again, we're selling. It's a great name to be able to sell. The volatility of it really can generate some decent income for the fund.
David, you have 4 new funds coming out. I know that you just filed for these. Give us your thoughts about why these 4 funds make sense coming out.
Yeah. Yeah. So we're excited for the funds to launch. Obviously, we're in a period where, I'm limited on talking about the funds, only what's based on in the prospectus. So pretty limited, but would love to come back on and talk about them when they launch. I think the best thing to think about is when you really think about, we can talk more about debasement and what's happening just from a macro level. But the whole idea for the launch of these funds is really to give investors choices that are outside of large cap and US tech. And so, and I've said this to you before, Brad, there's a lot of great ETFs. There's a lot of great income fund managers. And so for us, it wasn't enough to just come out with a fund that's similar to what someone else is doing with just a hope to choose us over them. We really want something different. And so if you look at the way our BLOX ETF is structured, where you have half the fund being commodities, right? In BLOX example, the Bitcoin and Ethereum, and then the other half being individual companies with real earnings and real profit. Call that your Warren Buffett sleeve, right? Your anti-Warren Buffett sleeve because he doesn't like commodities, and then your Warren Buffett sleeve, that real companies with real earnings. And so the idea was we can take that same structure and really apply it to a lot of areas. We can apply it to gold and silver. So the whole idea with gold and silver is going to be half the fund, or say there'll be a bucket, that a portfolio that will have direct exposure to GLD and gold underlying ETFs. And then there'll be the other bucket that will have the gold miners. And so exposure to companies that have real revenues and real earnings from gold and gold mining. Same thing with silver, right? Direct exposure to silver underlying for 40 to 50% of the portfolio. And then the other 40, 50% of the fund, direct exposure to silver miners. Why? Because silver miners have EBITDA, they have earnings, they have revenue. But what I also like about this is not that it's a leverage play on gold, but the company, if you look at the performance of gold miners and silver miners relative to gold and silver, what you'll typically notice is the miners generally are going to have a little bit more higher upside participation than the actual commodity itself. So again, when I think about I want exposure to gold, most of the times we just think, well, I'll just buy the commodity. Well, I want exposure to the whole universe. I want to own the miners. I want to own the suppliers. I want to own the development. There's much more that goes into just the end product, which is why these funds are going to be able to handle that. Really excited about just the nuclear sectors as a whole. Energy is, I think either I tweeted this out or Elon Musk did. I can't remember, but I remember reading recently where energy is the new gold. Right? In that, if you think about the need for energy going forward, I think it's more, we already know it's going to be a lot, but I think we're actually underestimating the need for energy. So nuclear, until we go to space and start getting energy there, nuclear is by far the cleanest most renewable. It's cheap relatively when you have the infrastructure in place. So there's a whole universe of nuclear that we want to have exposure to. And then we're also going to pair that obviously with the asset, which is the commodity, which is uranium for nuclear. So you're going to have exposure to uranium, and then you're also going to have exposure to nuclear companies. Defense and rare earth is another sector where, we believe hopefully that the world is becoming a safer place. But if you just see what's happening with NATO, hopefully we get resolution soon to wars in Russia, Ukraine, Middle East as well. But the reality is, if you had to ask yourself, do we think over the next 10 years we'll have less spending on defense or more spending on defense? We believe we're just going to have more spending on defense. Actually, NATO has committed, and we're seeing a lot of the growth in Europe. I'm not saying that I love going to Europe for wine, and me and my wife love spending a week there in the summertime. But Europe is not exactly on the cutting edge of technology and commerce. I wish they were. But what's going to drive Europe's economy over the next decade is defense spending. And so if you want exposure to non-US, I think you look at European defense contractors. So again, we'll look at defense contractors, we'll look at cybersecurity providers, and then pair that with rare earths. And again, rare earths is a very challenging thing to get exposure to, because when you look at the rare earth, China has a lockhold on a lot of the rare earth minerals that we need that go into F-35, palladium, steel, silver, steel. There's all of these inputs that we need for defense that unfortunately China has a pretty big stronghold on. But I think over time, US manufacturers and the US government is going to unlock access to a lot of these rare earths that I think could actually benefit us even more. So again, real assets, commodities, and then pair that with real companies with real earnings, and then overlay that same put spread, call spread structure, I think you could have something really unique, Brad.
You said debasement trade. Can you give a layman's term of what debasement trade actually means?
When you think about debasement, right, I think there's been a lot of that lately. If you think of the world post-COVID, right, when you look at inflation, when you look at the value of how far a dollar goes, when you look at wage growth, the challenging thing is when you have a government, like our US government, that keeps printing and devaluing our currency, what do we do? You could argue there's a lot of class warfare between rich and poor and left and right. But I tell you, we could probably account for 90%, if not more, of the wealth inefficiency, not because of what Republicans or Democrats are doing, but because of what the Federal Reserve has done over the last 4 decades. I would argue that the Federal Reserve is more to blame for really eroding the middle class than any other entity on the face of the earth today. And so the challenges, I was just having this conversation with a good friend, the challenge is, and this is why for young people, it feels like it's so hard to get ahead. If you don't own real estate and you don't own stocks, you have really been, in a sense, wiped out over the last 2 decades because of two factors. One, what our government is spending. So you have consistent deficit spending, which helps juice the economy, but it drives inflation. And then also what the Federal Reserve is doing by keeping interest rates low. So I know we all love low interest rates as a manager, great for stocks, but it really can do a lot to damage the middle class if they don't have access or ownership of hard assets. And so the debasement trade really it's your hedge against an out-of-control Fed and an out-of-control government. And so when you look at things like the debasement trade, right, gold has been a big part of that. Real assets like real estate. Bitcoin is I would say, the modern debasement trade as well. A little bit interesting of the thoughts on Bitcoin as well as part of that. When you think about, if you're a young person today, right, let's just say you're in your 20s and you're trying to buy your first home, or and you realize, I think part of why Bitcoin has done so well is Bitcoin was almost a way that younger Americans and I would say middle class to lower middle class Americans basically could put a stake in the ground and say, I'm going to do whatever I can to not erode the little wealth that I have that I'm trying to build. I can't afford a house. I may not be able to put a lot of money in stocks, but I can try to own this Bitcoin thing that can be my way to stay ahead and get ahead. And so it's really interesting, which I think why Bitcoin has done so well and why, as older Americans and are taking advantage of it well, but you really see it, millennials and Gen X that have really taken hold of that. But ultimately, the idea would be in a debasement trade, you want to own hard assets that allow you to have a fighting chance against inflation. So you think we have an issue now? Let's fast forward into 2026. You get 3 to 4 more rate cuts. Great for the housing market, hopefully great for stocks. But when you talk about the value of the dollar, we're probably going to have another great year for gold. We're probably going to have hopefully another great year for Bitcoin, because a lot of this has to do with the strength of the dollar. And I think you get continued pressure weakness on the dollar. We probably don't see inflation right away, but everything comes back to the mean. And if we give it a few years, you continue to deficit spend, you continue to keep rates low, you're going to get inflation. And so gold, Bitcoin, real assets, real estate are ways that you can really keep up, and silver, and try to stay ahead with what's happening with debasement. So I don't know if that answers it, Brad, but that's kind of my thoughts overall on it.
Fit into a portfolio.
Yeah. So again, everyone will have to make kind of a decision based on their own risk tolerance. But if you said, hey, David, if you were advising a client, where does it fit in? I would say we have some younger clients who the majority of their portfolio is crypto, and they're comfortable with more than 50% of a portfolio to have crypto exposure. So I think if some of it depends on age and your risk tolerance, but I think if I was going to create a perfect portfolio, I would look somewhere between 40 to 50% of equity exposure. So you've got, this can be whether through income funds or growth ETFs. So you want to own companies that drive earnings, that drive revenues each year, that can continue to grow over time, because equities are one of your biggest defenses against inflation over time. You got to have exposure to markets. And then I would pair that 50% with commodity exposure, 20 to 30% of whether gold or silver. I like a 10% sleeve of real estate. So we advise our clients to have at least 10% exposure to real estate. And then depending on your risk tolerance, right? You could be 10% crypto, 5% crypto, 20% crypto, up to 50% crypto, right? Of what that sleeve looks like. I think if you have, in a perfect world, you have equities, you have gold and silver, you have Bitcoin, and you have real estate. I think those asset classes right there are a total portfolio solution. Now, the percentages will be based on your risk tolerance, but to me, that just gives you broad exposure to really having a nice, well-rounded portfolio.
David, anything you'd like to finish up with? We really appreciate your time.
No, Brad, I know we went a little bit long, but no, just grateful to be here and excited. One, just want to say thank you for, we couldn't even think about launching new funds if our current shareholders didn't buy our current funds. And so really, really grateful for the support so far. We also, Brad, are working on other funds that are very unique. We also have some funds that are specific into the crypto space that are very unique as well, that we will be rolling out in 2020. We'll see. We may be announcing it before year end, but we will be rolling them out in 2026, and also some broad market exposure funds. So I'm just excited for the growth, because I really do think our goal, if you're buying an X funds fund, you're providing exposure to your portfolio that you really can't get anywhere else. So they're going to be very unique and hopefully fit a need that our shareholders are really looking for.
Thank you for everybody for watching today's episode. And until next time, God bless.
Did I convince you? Did I change your mind on it?
No. I just thought I'd throw that out since we were talking about it.
I owe you a beer a year from now if I'm wrong on this.
That's all right.